Yeah, I think about 195. I think net you still get a little bit of a positive jump. Well, with regard to what the Federal Reserve is watching, and of course investors, I think it's the unemployment rate, which I think has a good chance of staying unchanged, and the wage numbers. The headline number doesn't really concern as much, and I'll tell you why. Because what we've seen in the last couple of years, you're drawing a lot of people that were not in the labor force. We've drawn in almost 1.5 million people that were not in the labor force in the last couple of years. And then on top of that, we are not seeing as many wage pressures because you're seeing that component, part-time for economic reasons, as a percentage of the labor force, peaked at 6.7%. It's all the way down to 3%. That's one of the steepest declines that we've seen in any given expansion. And that's one of the reasons why we're not seeing as many wage pressures out there.
Is there anything in this expansion now? I mean, the age is long, but is there anything that you can look at, the underlying strength of it, that makes you worry that we're long in the tooth, or can this keep going?
There's a lot of things I look at, but the thing that makes me most worried is when you look at corporate non-financial debt as a percentage of GDP. That's flashing a yellow sign that suggests by 2020 we can move into some sort of a recession.
By 2020?
Yes.
So an actual two-quarter print of negative GDP?
Remember, that's the technical definition. The National Bureau of Economic Research looks at a lot of broader things. They look at industrial production, they look at personal income and the general economy. But you're right, the rule of thumb is 2 consecutive quarters.
And that's possible?
It is possible, yes.
Okay. Paulsen, I don't know, man. You're in a bad mood. I can't believe someone would even...
Smiling.
Yeah, but you should see what he's saying here.
Very negative.
Don't get out of equities completely yet. Just tilt away from U.S. stocks and diversify broadly. So, and go into emerging markets, which I've been hearing about for years and years, and anybody that took that advice wishes they hadn't. And you also think, finally, your commodity call is, you think is finally going to come true. A little bit early on that one.
Well, Joe, we've diversified. We've been in commodities earlier this year, and also more hedge fund approach. Some cash. As I said, moved away from the United States a little bit here. Emerging markets here have done very well in the last 2 months. Even though the markets have collapsed, they've been matching that performance. They haven't underperformed.
No, but they've been coming
overall.
Off the lows, off the underperformance for the last couple of years.
Yeah, that's right. Yep. Yep.
Right.
I just
it'd be great if you only said this 2 months ago, but that's really not the case.
Well, we've been a little concerned all year, and this has been a tough year in the markets. There's no doubt about it. And the problem all year has been really, I would say, overheat pressures. It's been Fed tightening, higher yields, and despite the fact we've had remarkable fundamentals on Main Street and great profits, the market hasn't been able to get a gain.
So,
and
Jimmy,
I think
what
might be turning.
Would you root? I don't want to say you want to root for bad jobs numbers today, but is there any part of you, or any part of you, that would actually root for bad numbers, because that would then maybe turn into some kind of Goldilocks moment to turn the Fed the opposite way, or at least hold them off a little bit longer?
Well, I think if you get bad numbers on the employment report, it's certainly going to be welcome news to investors, because they're going to anticipate the Federal Reserve is going to slow down.
Can I answer that question real quickly? Yes. We've done a lot of surveys on this, and I've watched the market. The market wants more jobs, much more than it wants the Fed not to hike. Over a short-term period, that may not be true. Over the longer term, the stock market likes growth and it likes jobs. A single report, it may want weakness, but not over the longer term.
Hey, Paulsen.
Steve,
go ahead.
I think the market, if you're a bull right now, I don't know what you're rooting for. I mean, if we get wage numbers that print 3.1 this morning on hot report, that's not necessarily good. On the other hand, if we find out manufacturing jobs are dropping as a lagged effect of trade wars or whatever, and bringing up the specter of recession sooner than 2020, that's not good. I think the path to Goldilocks here is really tough right now. That's kind of what I'm worried about. I don't even know what do you root for this morning?